probably see more risk of downside share price reactions in the small financial space this season versus consensus. We're at the very top end of Magellan for FY19, but that stock's factoring in a fair bit already, as I'll speak to. And we're actually quite materially below consensus on a number of the smalls into FY20, including Pinnacle, Hub24 and Flexi Group. Just on Magellan, obviously it's been one of the strongest, if not the strongest performer in the ASX 100 over this year, and this result will probably be likely to be the strongest in the financial sector. We're looking for EPS up 38%. That's following management fees up 27.5%, which are broadly in line with their average FUM over the year, up 28%. Magellan are closing or have closed 30th to 6th FUM at 86 billion. That's actually 14% higher than the average over FY19. So their FY20 outlook is pretty well supported where we are, and that FUM base is going to be really sticky. If you can see the performance numbers there in the bottom, they outperformed their relative index by 8% over the last 12 months. This is a chart I've shown many times talking about Magellan. It's the correlation of the share price of MFG to their underlying global fund, MGE. That's about 3 years of data to February. I think we managed to have it on a buy early in the year, but also managed to move back to a hold way too early. It used to be highly correlated, but as you can see, that's since February, and that divergence has been absolutely huge, primarily driven by valuation. So we've had some EPS upgrades over this half. Clearly the market's been very strong and their performance has been strong. But Magellan, as you can see in the right-hand chart there, PE relative to the ASX 200, now at pretty much all-time record highs at 1.7 times. The result itself, or the outlook, look, there's hard to pick apart anything in this result. I think they'll be talking more about the Australian retail product that they intend to launch with respect to retirement income. As we've seen with Magellan before, they can incentivise their investor base to put FUM in their funds pretty quickly, as we saw with MGG. So we could see another fund up and running pretty quickly in a space that is obviously in high demand. And the balance sheet's got 450 million and still of capacity in terms of the investments in cash. So hard to pick anything negative except valuation. The street generally, there's been around half the analysts moved to a sell. It's a pretty hard sell call on quality with this business. Clearly on valuation, there's reasons to take profits for clients. I think that's a pretty easy conversation to trim. It's a pretty high quality business, and don't underestimate what they can do with the balance sheet over time, but definitely susceptible to market pullbacks in the short term, depending on your view on global markets. Our valuation last set not that long ago, it's well under the current share price. Platforms, I won't dwell on these. I've talked a bit since initiating. At time of initiation, we highlighted that the short-term valuation metrics were pretty steep in light of some of the risks that are out there with these stocks, and they're well talked about risks. Ultimately, one of those came through quite heavily over the last month, and that's related to the cash rates. My stance here hasn't really changed. No, they're not well held in the network yet. But ultimately, those valuations are still really steep on a short-term basis, around 50 times PE. I think these sets of results can highlight some of those risks coming through. There's cost growth, there's revenue margin pressures. So ultimately, risk-reward still not quite there for me, despite a decent pullback. I am talking about them, though, because there is some really strong long-term macro thematics with these stocks. But ultimately, I think we'll get a chance a bit lower still. One stock that has drifted off a lot over the last 6 months is Pinnacle. It has been really weak, and as you can see in the right-hand chart, that's consensus estimates. My numbers are a bit lower, but the valuation now has become a really attractive level compared to what we've seen. Obviously, there are some risks to cause the share price to do what it's done. They are the performance of some of their key affiliates, Antipodes and Firetrail. If you follow the market there, investment performance over the last 12 months has been pretty dire versus benchmark, so that needs to turn around. And we've seen a washout of boutique fund managers this year. If you followed the news, there's been a lot of mandates pulled by big superannuation funds, put pressure on some boutiques which have closed up shop. So there is some risk in this business that there's some lumpy mandates that could be pulled. But ultimately, it's a pretty diverse business, and we're getting definitely more excited on this valuation. It's a very simple diagram on the right there, but the percentages are the earnings that come from each affiliate for Pinnacle. and the colours are my thoughts, representation of how the investment performance has tracked over the last 12 months. So not entirely dire across all affiliates. There is a good level of diversity. And ultimately, this is a really strong management team, good balance sheet. And as we've seen with Magellan, when performance turns, you can really get some upside leverage in these businesses. My view, I have been positive on the stock from a quality perspective. I am suggesting just wait. The result's actually out tomorrow. We downgraded earlier in the half a couple of months ago. Consensus hasn't followed, so we sit well below consensus for this result in FY20. So I think there's actually a bit of downside risk in terms of result reaction tomorrow. So I'm just holding off to see that, and also get a bit more clarity on how lumpy there could be in terms of mandates with large super funds. I think that risk can pass through the result when they provide some commentary. So definitely one to be putting on the radar over the next 2 years. I think we can see some really strong upside in this stock with Antipodes hopefully turning their performance. Just wanted to mention Credit Corp. It has already reported. I've talked about it a few times. I know it's not an easy stock for retail advisors to talk to retail clients, given it's such a niche industry. Debt collections, not something that everyone talks about every day. But in terms of the outlook for the stock and the track record, the left-hand chart, there's actually their EPS track record. It's pretty impeccable in terms of a mid-cap industrial, really strong track record for this management team. To touch on some of the upside, they have a US business that has been performing really well. It's delivering 8 million, or forecast to deliver 8 million of profit this year. As a comp, the domestic business does 45. So there's a really strong runway for that business to at least match the Australian business. They raised 140 million earlier in the year. They expect to deploy that in the Australian market with acquisition and capital deployment opportunities. They've got a good track record of hitting their ROE targets. So for me, it's got a really clear organic growth profile, some acquisition upside over the next 12 months. I think we'll see guidance upgrades over the next 12 months coming through. It's pretty expensive on a short-term basis, but I think the share price will track higher over the next 12 months.